Welcome to the second presentation of the 3 audio presentations on the lecture on financial economics or personal finance. So in the first segment, we discussed the importance of compounding and found out how the future value of money is calculated. In this segment, we'll discuss particular investment instruments that are available to us so we accomplish our investment goals. So the main commodities to invest in the US dollar today are securities, real estate, and businesses. Securities are simply financial instruments like stocks, bonds, or CDs. So they are bought and sold in the stock market every day or in their respective markets, bond markets, and the main advantages of this type of investing is that they are really easy and quick to buy and sell. And the term to sell an investment is to liquidate. So liquidating a securities investment is all a matter of just pushing some buttons on the computer, since most online brokerages now allow you to buy and sell your own investments today. And then within just a day or two, business days, you would see the actual money, the value of your sold security in your bank account. So it's very quick to buy and sell in comparison to real estate investments like housing or businesses. Secondly, it also allows investors to invest with very small amount of money. So you need large sums of money to buy a house, even to pay for a down payment, tens of thousands of dollars, but just $100 would be enough, or even less actually. $50 could be enough to buy a share of stock or a bond, that's what have you, in the securities market. So that's a major advantage, which means that every beginner investor must begin his investment venture with a securities type of investing and then try other forms. But the main disadvantage of securities investing is that it's a more volatile type of investing, which means investment's value fluctuates over time much more than real estate values do. So this brings us to the notion of risk. Risk in investing refers to a bit different thing than what we understand in our daily lives. Normally, we think of this term as the likelihood of someone losing the money he invests. But in the investing world, the term risk refers to the extent to which an investment's value fluctuates. So imagine that you plot the values, let's say monthly values of your investment on a graph over time, and then you created a graph, and you just simply create a straight line that shows the averages of those numbers on an ongoing basis, and then you calculate the differences between the actual values and that average. What the notion that mathematicians call standard deviation, and this notion refers to the risk level of that investment. So in other words, how much the value of your investment is fluctuating up and down. More it fluctuates, more risky it's considered to be. So when we classify securities according to their risk level, we see that there are 2 main types. There are those lower risk type of investments and higher risk type of investments. Lower risk type of investments are called fixed income investments. And these type of investments come with a predetermined return rate. So you invest your money, and from the get-go, you know what return rate you'll get from that investment. And as a result of this guaranteed return rate, if you will, the return rate wouldn't typically be high in comparison to higher risk investments. So specifically, the lower risk investments are bonds and CDs, which we'll discuss in more detail later on what they are. Higher risk investments on the other side are called equity investments, and these type of investments do not have a guaranteed rate of return. The investor would have no idea how much the money would be, whether or not it's going to go up or down in the future. So he's taking a risk with it. So accordingly, the return rates would vary quite a bit. They're not fixed. And stocks and mutual funds are the two main instruments in these types of investments. We go back here, which come with the some certain tax advantages as well. But in terms of the agreement, it's more or less the same. So pros and cons of fixed income investments. Pros are that investor knows what his return will be from the investment, which is the main appeal of this type of investments. And accordingly, typically conservative type of investors who cannot tolerate risk much would appreciate fixed income investments. On the other side, the negative aspect of this type of investment is that the return rate would be really low in these. It barely keeps up with inflation. So basically, they're not real investments in the sense of growing the purchasing power of your money. They are just more like places to park your money so that it doesn't lose its value against inflation. And this notion of low risk, low return is consistent with the main rule of investing, which says that higher the potential return a person expects from his investment, higher the risk that he needs to be able to tolerate. Equity type of investments on the other side, which are stocks and mutual funds, they are those whose values are not predetermined. So stocks are ownership shares to a company. They are bought and sold in the stock exchange markets. There are 13 of these markets in the US and 47 other ones outside the US, so for a total of 60 stock markets in the world. But the largest one is the New York Stock Exchange in the US. So when an investor buys a new issue called IPO, initial public offering, which is when basically you're buying a brand new share that no one else bought before from the company itself, then your money goes straight to the company and capitalizes it. But if you buy it in the secondary market, as most of us do most of the time, when you buy a stock share, then it goes to the seller of that share. So I may have a share of XYZ company and I may sell it in the stock market, and then you may want to buy that. When you do, then your money comes to me and my stock share goes to you without the company involved in the middle. Mutual funds are the second type of equity investments, and these are basically baskets of stocks and or bonds. So imagine that hundreds of companies' stock shares are included into a basket, and the shares to that basket is sold in the stock market. That would be a mutual fund. And the main advantage of this is that it offers diversification to the investors, because no matter how good a company is, it's still one single company and its executives whose judgments determine the value of the stock's price. Whereas when you invest in mutual funds, it's hundreds of different companies and thousands of people and their judgments. So accordingly, you would be spreading your risks over many dynamics, which means that if one company makes a bad judgment, then your overall investment doesn't go down the tube. So that's the main appeal of mutual funds. That's why they were created. They bring similar returns to stocks, but for a significantly less volatility or fluctuation in value. You can just come up with this 1 million figure by using the compound interest formula by yourself, which I suggest you do. Second principle of investing is that you spend your money as little as you can. So, being thrifty. Everybody needs to take pride in being thrifty, being financially conscious. I realize we live in the consumption society and it may be difficult to be thrifty at times, but if a person buys what he or she needs instead of what he or she wants to have, then that would be being thrifty and it would be a smart thing to do. Also, there are many other ways of being thrifty, such as buying things used as much as possible and not buying things often also. So observe these simple ideas and you would be impressed how much money you're saving, which in effect is similar to someone increasing your income, keep giving you bonuses. Sweden makes a good example for all of us. It's a rich, prosperous, and a highly advanced democratic country with a similar income to the US's, but the Swedish nation is notorious to observe moderation in its life. People there simply buy everything in moderation just to satisfy their basic needs, and they frown upon the notion of luxury. They even have a term for this. They call that cultural norm lagom in Sweden. The third principle of investing is that turning savings into investments as soon as one can. So, in other words, not waiting for the right time to invest. And the reason is very simple. The returns from investment, what your money is going to be in the long run, when it's time for you to liquidate them, is a function of both the return rate and also the length of time that passes. Because compound interest is so powerful, the length of time, investment time, is very important in determining what the outcome will be. So accordingly, one needs, and because we cannot also predict the future, it is not an intelligent thing to do to wait for the right time to invest in something. When a person has some savings, as soon as he or she has some savings, saved up money that he or she doesn't plan on using for a while, then he or she should put that money into investments ASAP. So if a 20-year-old college student starts saving and investing $100 a month now, instead of a year later, for example, and earns only 6% on it every year, he or she would have $15,000 more when he or she retires. That is the difference that such a little 1 year makes in a person's portfolio. The fourth principle is investing for the long term. This means that in finance or investing, long term is defined as 10 years. So do not sell your investments before 10 years unless you absolutely have to do it. So investment is a long-term activity. Trying to profit from investments on a short term by buying and selling investments quickly is called day trading, and that is not a wise thing to do. It's a very risky behavior. It's not much different than being a gambler. Proper investing involves a long-term outlook, which, by the way, is much more difficult to do in real life than to say. I have to honestly tell you this, especially in difficult times when the stock market goes down. Everybody's reflex perhaps naturally becomes selling in order to cut down the losses. But one needs to, a smart investor would just simply stay on course, have trust in the market, and know that he would recover in the long run if he doesn't sell his shares. This wraps up our discussion, and I'll continue in the next lectures.